Guys, Square, now called Block, is up 10% year to date, which I'm kind of surprised about because Bitcoin is up, 80%, 85% year to date? What are you smiling about,
I'm actually
Mo?
shocked to see that they're only up 447% over 10 years, because we were just looking at NVIDIA. Let's pull this up just for a quick comparison. This is up almost 12,000%.
Now, different companies,
but still, this was on the hype train. And the only reason I say that, look at this chart. Look at where this was.
All-time high, 289.23 on August 5th, 2021. 52-week low, November 4th, 2022. Mo, there's so many 52-week lows at that date. 11.3, 11.4. Meta was 11.4 at $88.
Wow.
And now Meta. Guys, we've said it before. We think we're in a bear market rally. We don't think this is going to sustain. If you are interested in hearing more about that, subscribe to our channel. But in this video, we're going to go over our process of thinking about companies. When you buy a stock, you're buying a piece of a business. And if you pay a reasonable amount of money for that business, as the business gets better or worse, the stock will likely correspond. Okay? That's the big thing we want you to understand here. There's going to be things in this video for beginners. There's going to be things in this video for advanced people. Please stay all the way through, because we're going to talk about a lot of this. But Block here used to be Square, the processing company for credit cards. They changed to Block as a way of jumping on the crypto kind of bandwagon.
That worked out well.
And this started with the guy who started Twitter. What's his name?
Dorsey, Jack
Dorsey. I'm always thinking about, when I say Dorsey, it's that movie, The Cutting Edge, from like 1993, which is like the best rom-com of all time.
I always think of Ken Dorsey. Remember the quarterback from Miami?
Oh.
Back in...
Did he play for the Browns? He was the GM.
He got drafted by
Who was the GM for the Browns, Dorsey?
Drafted by the Niners.
Who drafted Manziel? John Dorsey? Yeah. He drafted Manziel. Didn't he draft Manziel? Drafted Baker. That is correct. Drafted Baker, yeah. Okay, so...
That turned out well, too.
Too soon. So, $18.5 billion in revenue, $43 billion company, $18.5 billion in revenue, but still lost $353 million. It's 5-year PE. Now, guys, what 5-year PE means, we take all 5 years of their profit, the last 5 years, we average it out and divide it into the market cap. It's 1,177.
That's pretty low.
Let's look at another company that we think is overpriced. Let's look at Microsoft and see what their 5-year PE is. And we think Microsoft's overpriced, 44. So, does that mean you should avoid this company? Not necessarily. We're going to go over some more things here, our 8 pillars, analyst estimates. A company can be growing. I mean, $18.5 billion in revenue is not something to sniff at. That's a lot. Mm-hmm. That's really a lot of money. But they're doing payment processing, and they've done a great job of it. Let's go look at their income statement. Mo, check out their revenue growth.
Let's see here.
Look at the growth during COVID.
Oh, I'm sure it's enormous. Holy moly.
Because look at this, Mo. This is this was the start of COVID right here, literally March of 2020. Mm-hmm. Look at this massive jump, and they sustained it.
Yeah,
they sustained this growth. Because guys, remember when COVID happened, between this time, you could only buy online basically for how much of it, but they still sustained this growth, which is awesome.
Yep.
The one thing
it was almost like a kickstart for them instead of a something where it jumps up and then they have to come all the way back down.
So that's the comment I was going to make. So many companies during COVID, like shipping companies, had a massive increase in shipping, and we said, wait a second, be careful here.
Yeah.
Because it was because of excess demand and limited supply, so why these revenues skyrocketed. This is sustaining here and still growing. That's a major plus for the company. So let's go look at their profitability. They had 2 years of profitability in the last 5, actually ever. All right, they're still losing money. One of the things I want to look at is their shares outstanding. Oh my lordy.
Is it nuts?
Guys, this is huge. 10 years ago, they had 284 million shares outstanding. Today, they have 602.
Yikes.
So for those of you who are new to the channel, this is why I want you to subscribe to us. Not many people look at this, but this is a very important aspect of investing. This I call the silent killer of investing. What's happening here is you're being diluted. So what that means is, let's say a company has 10 shares outstanding and you own 1. You own 10% of the business. If they issue 2 more shares, you still own 1 share. But now you're splitting the revenue, profit, and everything by 12 shares instead of 10. So you went from 1 out of 10 shares to 1 out of 12 shares. You went from 10% ownership to 8.33% ownership. In this situation, if you own the stock 10 years ago, you're getting less than half of the ownership you originally had.
and I broke this down to quarterly just to see if they were slowing, they are still diluting you. I was hoping that they would be retracting.
So why do companies issue shares, Mo?
So they don't have to take on any debt.
Yeah, and especially if their stock is overpriced.
Yeah, people are going to go buy it, so why not?
So to me, this is Square saying, man, our stock is really overpriced. Let's just give the shares away. People will buy it, and we'll get cash in, and we don't have to owe the money to somebody someday.
Right.
When was their peak? It was October of... So how many shares did they issue? Let's see how many shares they're issuing back in October of 2021.
Okay. Let's go here.
Right here.
Quarterly.
Actually, not as many as you'd think.
When was there?
So isn't that weird? As the stock started to fall, they issued more and more shares.
Yeah.
That's nuts.
Yeah.
So they buy into their own hype train.
Yep.
You ready to see the 8 pillars, Mo?
I guess.
Oh, there we go. You guys remember, if you have our software, you can customize your own pillars here, up to 12 of them. And there's like 4 quadrillion different variations. But look at this, guys.
Of course.
Now, again, you don't just buy or not buy based on the pillars. Right. It's a screening out process. It's the way of looking at it and telling a story. So what's the story you want to learn here?
The story is they can generate revenue, and that's about it. Everything else is a mess right now.
In fairness, though, Mo, when companies are growing,
they're in ultimate growth phase right now.
They lost $300 million, but $18.5 billion in revenue. What's their gross margin? 35%?
Yeah.
What's another payment processor we can look up? PayPal. I
will say, like, I look at shares outstanding. That's the one that bothers me.
Oof.
ROIC doesn't really bother me right now.
Yeah.
PE, it bothers
me.
Look
at PayPal's gross margin, 49%.
That's a big
That means for every dollar PayPal sells, 49 cents goes to the bottom line before taxes. And for Square, it's 35%. That won't be affected as much. Well, it could be if they put a lot of marketing costs in there, but that won't be affected as much with gross margin. On the bottom line, yeah. Guys, they're pretty close to profitability. The question is, are they going to generate enough profit to justify $43 billion in value, in market cap? They very well could. But you need to understand that when going forward, because every investment is the present value of all future cash flow. Just think about that for a second. If you're new to our channel, I want you to hear that. If I asked you for $10 today, and I said I'm going to give you $1 for the rest of your life, you've got to determine things like, how likely is it that you live a long time? How many years do you expect to live? How many years do you expect me to live? Because if I'm not alive, I can't give you that money anymore. And is my business going to get better? Well, it'll be easier and easier for me to pay that money. These are the things you have to ask. Same with a company. When you pay $43 billion for a company, because that's what you're doing when you buy the stock, are you going to be able to get a good return on that money as time goes forward? That is the question. So let's see what analysts are saying. Mo, why don't you go over what analysts are saying here?
Okay, let's see here. So analysts, big earnings per share growth. I mean, what is this average? Probably high 30s. It's pretty good. I don't know. They're not seeing any type of pullback on their growth.
And they're seeing profit this year of $1.76 per share.
That's the interesting thing.
Which still makes it a, 35 PE, 34, something like that.
The revenue side, I actually expected a little more on the revenue side. It's about 15% average over the next 5 years. I expected a little bit more revenue growth.
Well, remember, it's stabled off here, Mo. Look at the income statement. It went sky high, 5.3, and then started to stable off here. Yeah. 15% still a lot.
So something interesting that they have done, they've bought some technology where they've turned the Android device into their payment processor. So you know how on the iPhone you have to put that little chip in the bottom?
Yeah.
This one you just like tap somebody else's phone.
Oh,
that's pretty cool.
That is cool. By the way, their device is pretty easy anyhow for Square.
They're getting into the banking. They're getting into a banking area.
So what are some
Square credit card they have?
Okay, so what are some bull cases for Square? Because one of the things we want to do on this channel is talk about bull and bear cases, and Mo likes to go through them.
So they've acquired a Afterpay, which is a buy now, pay later platform. So that's something that everybody's getting into.
Oh boy.
I don't know how you're going to compete with Apple. What's the other one?
Affirm,
that one. Interesting. Cash App has grown. This one's huge. Monthly active card activations have grown 35% from 2021. And you can see here on this little chart the growth that they've had. Now, bear cases, growth projections have come down from the projected 43% CAGR in revenue to 15% year over year. Yikes. The company bought back 4.73 million shares.
Yeah, but
while having stock-based capital. You know, when it comes to the share, like I look at their share thing, it's just all a disaster right now.
Yeah,
so it's not going to get any better anytime soon. That's my opinion.
I don't like buying overpriced companies that issue a lot of shares.
Yeah.
I get why they issue the shares. I 100% understand it.
Yeah.
But you've got to remember, there are a lot of investors out there who won't even look at a company if they don't have less shares than they did 10 years ago.
Yeah.
That's one of the smart things about good investing, good capital allocation. Are you buying back cheap shares? Not expensive shares, cheap shares.
Yeah.
Because guys, when you buy a stock, you basically get a piece of that company's balance sheet. You get a piece of that cash in their account. So they go back and buy their own expensive shares, they're misallocating your capital. But if they buy back cheap shares, they're doing a great thing. It's like they're investing in a company at very low levels. What else you got, Mo?
So they are buying back these shares all while having operating losses.
But by the way, then they're issuing stock-based compensation, which means they're issuing shares to their executive team. It's just a very tough. The stock is tough right now.
Yeah, so this is a very hard one when we put it in Stock Analyzer.
So right now, let's look at the quarterly numbers, because if the analysts are expecting $1.76 in profit, how are they going to do that this year? $1.76 times 600 million is what? So they have 600 million shares outstanding. If they make $1.76, that's $1 billion in profit divided by how much revenue are they going to have this year according to analysts?
Let me go back here.
20.67.
Yep.
So it's about 5% profit margin. Okay. The reason I looked that up is now we're going to go to our Stock Analyzer tool. Now, guys, there's a reason why this is the most popular part of our site. It was used 1.3 million times last year by our users. And guys, if you're interested in having our software plus all of these tools right here, all of these tools, including our real estate calculator, which will become its own separate piece soon. So if you sign up now, you would get this real estate calculator included as part of your package. You don't have to buy it separately in the future. It's $7 for 7 days, $1 per day. Go to everythingmoney.com. This will absolutely change the way you look at money. You get everything you've seen, plus our community of 1,000 investors that talk every single day, thousands and thousands of messages. You absolutely have to do this. $1 per day, guys. You spend $1 per day on such useless things. Why not change the way you look at money? But for its Stock Analyzer tool, it allows us to make assumptions about the future. And based on those assumptions, it'll tell us what price do you need to pay for the stock today to make it worthwhile, okay? Now, the hard part about Square is what? We don't have much profitability here.
That's the thing.
So we're gonna be doing a lot of guessing here on the profit margin and free cash flow margin.
Yeah.
But let's do a, Mo, I actually don't want to even do a 10-year analysis. We can do 1 to 20. Let's do a 5-year analysis.
Okay.
And let's base it on analyst expectations.
Okay, that's probably the best thing that we can do right now.
That's about all we can do right now.
Yeah.
All right, so revenue growth. What were the numbers?
They said 15%.
So let's do 10, 15, and 20%.
Okay.
So 10 is they don't do as well as analysts think. 20 is they crush analysts. Crypto becomes something that I don't think it's become. It becomes awesome, et cetera, et cetera. Okay, now profit margin. They're expecting 5% this year.
Why don't we go 2, 5, and 8?
See, I was actually thinking 5, 10, and 15. And the reason being is...
You think they can do... Let's see.
But they have 35% gross margin.
Yeah.
So let's say they crush it.
Okay.
Mo, part of the reason is we want to also put really high numbers in here, because if the really high numbers come in at a price still lower than the current price, it just shows how overvalued the company be. That's the big benefit of the Stock Analyzer tool, allowing you to do 3 different levels. Mm-hmm. Go extreme on the low and high. Now, I don't think 5% was extreme. It was extreme. Go ahead, Mo.
I don't know if they can... I mean...
I don't think they can do 15%.
I don't know if they can do 5%. They could keep losing.
You know what? Let's do that then.
You know
Let's change it. Let's go to 2.5, 7.5, and 12.5.
Okay.
How about that?
Yeah.
I think they're still going to lose money this year.
That's what I think.
All right. Yeah. Free cash flow. I just say free cash flow has actually been better than profit. So let's go 3.5, 8.5, 13.5. Because if you look right here, guys, I compare these two. Okay, free cash flow has been better than profit margin. Great. I prefer it that way. Mm-hmm. I don't like it when it's the other way around. So that's a big benefit of companies that are growing. Palantir is the same thing. They are showing higher free cash flow than profit. That's a very common issue when they're depreciating. I don't want to get in the exact accounting of it. I said science. The accounting of it. But they're depreciating a lot of their stuff. All right. Now, what PE are you going to assign, and what price of free cash flow do we assign to a company like this?
16, 19, and 22.
Fine by me. Guys, the historical average for the market's 15 or 16. So Mo is applying a very aggressive PE, but it has a lot of growth potential. It's very convenient.
It is.
It's making a lot of headway.
Yeah.
Now, what return do you want? Now, guys, this is the big one. Your desired return is essentially your margin of safety, and we've all heard about margin of safety. The higher your desired return, the more margin of safety you need, therefore the higher return you need. The more return, lower the price, right? That's the big thing. If you pay $100 for this iPhone, you're gonna make a higher return than if you pay $1,000 for this iPhone. That's the key. So, Mo, what's your minimum return? And remember, it differs from company to company. If we were analyzing Apple and Microsoft, we're probably okay with a lower return than if we go on a company that's losing money and still has a lot of unknowns.
I'd probably go 13% on the low end.
Great. Middle?
15 and 17.
Okay.
And I could even go higher on those, on the mid and high.
I was thinking 13, 16, 19, but I say we stick with 13, 15, 17. Guys, remember, you can get 9 or 10% by investing in a long-term ETF over long periods of time.
Yeah, if I'm going to take this risk, I want extra return.
Exactly. There's a lot of unknowns with this company. They're still losing money. They're still issuing a lot of shares. You need to get that extra return.
Right.
So, guys, we're going to go over the numbers here, but I want you to do me a favor. Stay through the entire video. I'm going to explain a lot more here through the video about these numbers. It's very important you do that because there's a lot more data on this that's awesome that'll really help make your decision. Boom. All right. Low price, 14 to 19. High price of 112 to 121. Mid price of 53 to 60. So guys, if all of your low assumptions occur, you need to pay this price. And if you pay today's price and your low assumptions occur, you're going to lose about 15% a year based on those assumptions. For your middle assumptions to occur, you got to pay 53 to 60. And if you pay today's price, you'll make 10%. Not bad. Still not bad if these middle numbers are okay for you. And if the high numbers, the high assumptions happen, you're going to make 31% of your money buying it for today's price, and it's worth 112 to 120. So guys, as you can see from this, it all depends on your assumptions about the future. So if you like this and you see the value in this tool, everythingmoney.com, $7 for 7 days, $1 per day. Sign up right now. Thank you very much for your time.